Construction permits, obtained. Land, secured. EPC contractor, shortlisted. Offtake agreement, negotiated. Financial model, completed. Independent review, commissioned. And then the developer approached the DFI. 12 months of correspondence, 14 information requests, 3 revised financial models. And the DFI's response? Not investment ready. The developer did not have a bad project. The developer had a bad DFI engagement strategy. Episode 11 shows you what that strategy must look like and what it costs when you get it wrong.
Zara. This is the episode developers most need and most often skip. Everyone wants to know how to build the financial model, structure the offtake, negotiate the EPC. But those deliverables only matter if you can actually get them in front of a DFI that will finance the project. The engagement strategy is the bridge between project development and financial close.
And it is a strategy, not an application. DFI financing is not a form you fill in. It is a relationship you build, a readiness you demonstrate, and a process you manage through 8 distinct stages, each of which has its own requirements, its own risks, and its own timing. We will cover all of it. Let us start with what a DFI actually is and why its capital is structurally different from everything else available in the market. A development finance institution is a publicly mandated lender whose purpose is to finance projects that commercial banks will not. The reason commercial banks decline is usually the same. The tenor is too long, the country risk is too high, the project risk is too complex, or the returns at a commercial rate do not justify the exposure. DFIs exist precisely to fill that gap. Their capital comes from shareholder governments and capital market borrowings, and their mandate is development impact, not profit maximization. This means they can offer tenors of 15 to 25 years, accept country risk that commercial banks price out, and deploy technical assistance grants that reduce developer costs during project preparation.
But DFIs are not charities. They are structured lenders. They require bankable documentation, they apply rigorous due diligence, and they will decline projects that do not meet their credit standards or their environmental and social requirements. The difference from a commercial bank is not that DFIs are easier. It is that DFIs can go where commercial banks cannot, if the project is properly structured.
The DFI landscape for African infrastructure includes 6 primary institutions that developers will encounter. The African Development Bank, AfDB, operates both a sovereign window for government borrowers and a non-sovereign operations window for private sector transactions. The International Finance Corporation, IFC, part of the World Bank Group, is exclusively non-sovereign, lending to private sector projects. DEG, FMO, and Proparco are the European bilateral DFIs, each with a specific geographic focus. And the U.S. Development Finance Corporation operates across emerging markets with a particular focus on the DFC priority regions. All 6 require IFC performance standard compliance as a condition of lending. There are 5 structural advantages that make DFI capital different from commercial bank debt. The first is tenor. A 15 to 25-year infrastructure loan is not available from a commercial bank for most African projects. DFIs provide it because their liability structure supports long-dated assets. The second is pricing. Concessional windows, particularly for climate transactions, can reduce the all-in cost by 2 to 4 percentage points relative to commercial bank debt. For a $100 million project, that is a material reduction in annual debt service, which directly improves your DSCR.
The third advantage is catalytic effect. When a DFI commits to a transaction, other lenders follow. Commercial banks, export credit agencies, and bilateral lenders all treat DFI participation as a signal of project quality and political risk mitigation. A transaction that IFC has reviewed and approved is a transaction that DEG, FMO, or a commercial bank will look at more seriously than a transaction that has not been DFI reviewed.
The fourth advantage is technical assistance. AfDB and IFC have project preparation facilities that provide grant-funded support for feasibility studies, ESIA preparation, and financial model development. For developers working with constrained preparation budgets, this assistance can be the difference between a project reaching investment readiness and a project stalling at pre-feasibility. And the fifth advantage is ESG credibility. A project financed to IFC performance standard provides a sustainability credential that supports green bond issuance and ESG-linked refinancing at project completion. Before you approach a DFI, your project must meet 7 readiness criteria. The first is a bankable offtake agreement, signed or substantially negotiated. The DFI will not seriously engage with a project whose revenue is a forecast. The second is secured land with either title, a long-term lease, or a credible legal process for acquisition. The third is an ESIA framework commitment, at minimum, a scoping report and adoption of the IFC performance standards as the governing ESG framework. The fourth is a shortlisted EPC contractor with an advanced technical design. A conceptual design is not sufficient for DFI engagement.
The fifth criterion is a bankable financial model, DSCR of at least 1.3 times at the base case and at least 1.1 times in the downside scenario. The sixth is confirmed equity commitment from the sponsor. A DFI will not be the first money in and the only money in. They need to see that the developer has skin in the game. And the seventh is a track record. The development team must be able to demonstrate experience in the sector, the geography, and the project type. A first-time developer in an unfamiliar sector faces a much higher hurdle.
These 7 criteria are not bureaucratic checkboxes. They represent the minimum level of project maturity that allows a DFI to begin a meaningful diligence process. A project that does not meet these criteria when it approaches a DFI will either receive a polite decline or will spend months in correspondence before the DFI concludes it is not yet ready. The developer who presents a project meeting all 7 criteria on day 1 compresses the engagement timeline significantly. 6 months of preparation before approaching a DFI is worth more than 6 months of DFI correspondence on an underprepared project. The DFI engagement journey has 8 stages and takes between 12 and 24 months from first contact to financial close. Stage 1 is project identification. You send a 2-page concept note to the relevant DFI sector specialist. Not a 100-page report. A 2-page concept note that states the project, the sponsor, the development stage, and the DFI ask. Stage 2 is early engagement. If the DFI responds, you have an introductory meeting where they assess fit against their mandate, their pipeline, and their country strategy. Stage 3 is submission of the full Information Memorandum. Stage 4 is the DFI's initial review and clarification request, typically 4 to 8 weeks. Stage 5 is formal due diligence across 4 parallel work streams.
Stage 6 is credit committee, the DFI's internal approval process, which can take 2 to 4 months and involves multiple review layers: sector, risk, environmental, legal, and senior management. Stage 7 is the term sheet, indicative financing terms issued for negotiation. And Stage 8 is financial close, all conditions precedent satisfied, all documentation executed, and the first loan disbursement made. The critical insight is that each stage gates the next. A weak information memorandum delays or kills the initial review. An inadequate ESIA delays or kills due diligence. A developer who tries to rush the process by skipping stages does not accelerate close. They create rework that adds months.
The Information Memorandum is the single most important document in the DFI engagement process. It is the document on which the DFI bases its initial assessment and its decision to commence formal due diligence. A strong IM opens the DFI's door. A weak IM closes it. The IM has 10 required sections. The executive summary must state the project clearly: sector, country, capacity, total project cost, DFI ask, and key financial metrics. DSCR, equity IRR, and offtake counterparty. The executive summary is not the place for aspirational language. It is the place for precise, bankable data.
The sponsor profile section must address track record directly. A DFI is lending to a project company backed by a sponsor. They need to know that the sponsor has completed comparable projects, has financial capacity to inject equity on schedule, and has a governance structure that is transparent and manageable. Developers sometimes underinvest in the sponsor profile section because it feels like self-promotion. In fact, it is credit assessment, and a weak sponsor profile is a reason to decline before the financial model is even reviewed.
The financial model section of the IM is not a summary of the model. It is a presentation of the model's conclusions, under DFI base case assumptions, not under sponsor optimistic assumptions, DSCR at base and downside, equity IRR at base and downside, debt sizing rationale, sensitivity table showing the 2 or 3 most material variables. If the model has been independently reviewed, state that explicitly. It accelerates DFI confidence. The risk matrix section must identify the top 10 project risks, the mitigation for each, and the residual risk after mitigation. The DFI will produce its own risk matrix. Presenting yours first demonstrates that you have thought rigorously about the project's vulnerabilities. The first approach to a DFI must be targeted and disciplined. Target the right DFI, the one whose mandate, geography, and sector priorities match your project. Do not blast the same email to 12 DFIs simultaneously. DFIs talk to each other. A project that is known to have been rejected by 3 DFIs before approaching a 4th faces reputational headwind. Contact the sector specialist for your geography, not the general inquiry email, not the country director's assistant, and not the communications team. The sector specialist is the person who will own your project file if the DFI engages.
The first communication should be a 2-page concept note, not an IM, not a teaser deck, not a 60-page feasibility study. The concept note states project name, country, sector, capacity, total project cost, DFI ask in dollars, development stage, key project agreements in place, and sponsor profile in 2 sentences. The purpose is to get a meeting. The IM comes after the meeting, once you know the DFI is interested and you understand what they will prioritize in their review.
DFI Due Diligence runs across 4 parallel work streams. The technical work stream is led by an independent engineer appointed by the DFI. The IE reviews the EPC scope and EPC contractor qualifications, the technology performance data, and equipment warranties. The site conditions, including geotechnical reports, hydrology, and grid connection studies, and the construction schedule, specifically the critical path, contingency float, and major risk events. The developer must cooperate fully with the IE, delayed responses to IE queries, delay the technical DD report, which delays credit committee.
The financial work stream is a model audit. The DFI's financial analyst reruns your financial model using DFI base case assumptions, which will be more conservative than yours. They test DSCR, LLCR, PLCR, and equity IRR at base and downside. They check for circular logic, error traps, and assumption consistency. They will run their own sensitivities. If they find errors or inconsistencies, they will send a query list. The quality of your response determines whether the financial DD concludes in weeks or months.
The environmental and social workstream audits your ESEAA against IFC performance standards 1 through 8. They conduct a gap analysis, comparing what your ESEA covers against what the IFC PS requires. They will assess whether the RAP for resettlement is complete, whether the community engagement has been genuine, whether the grievance mechanism is operational, and whether biodiversity and cultural heritage have been adequately screened. The legal workstream reviews all project agreements, offtake, EPC, O&M, land, and the SPV structure, the security package, and all regulatory approvals. Legal DD is where undisclosed liabilities and structural weaknesses in project agreements typically surface. The financial model review deserves specific attention because it is where many DFI processes stall. DFIs will rerun your model under their own assumptions, and the first thing they will check is DSCR. If your base case DSCR is 1.35 and the DFI reruns it under their assumptions, which include a higher discount rate, a lower capacity factor, and a slower revenue ramp, and the DSCR falls to 1.1, the DFI will send a query asking you to explain the assumption differences. This back and forth can take weeks. The developer who anticipates DFI assumptions and runs their model under DFI base case conditions from the start reduces this rework to a simple comparison exercise.
The model also needs to pass a structural audit. Circular references in the debt sizing loop must resolve cleanly. The cash waterfall must follow the correct sequencing. Operating costs before debt service before reserve account funding, reserve accounts before equity distribution. Reserve accounts must be correctly sized, typically 6 months of debt service for the DSRA, and a major maintenance reserve calibrated to the O&M plan. If the model was built by the developer's internal team without external review, the DFI will treat every assumption as unverified. An independent model review, even a limited one, signals rigor and accelerates financial DD materially.
The term sheet is the DFI's indicative financing offer. It is not a binding commitment. It is an expression of terms on which the DFI is willing to proceed to formal documentation. There are 10 provisions in the term sheet that every developer must understand before negotiating. The facility amount and currency. The DFI will typically offer less than you asked, and in the currency that minimizes their FX exposure, which may not match your project's revenue currency. The tenor and grace period. Negotiate for maximum tenor, because every additional year of tenor reduces your annual debt service and improves your DSCR. And the interest rate structure, floating rate indexed to SOFR or Euribor, plus a credit spread. Understand what moves the spread before you try to negotiate it down.
The fees section requires careful review. Front-end fees of 0.5 to 1.5% of the facility are payable at signing and are often non-negotiable. Commitment fees on undrawn balances of 0.25 to 0.75% per annum accrue from signing, so the developer who takes 18 months to draw down pays significant fees on undrawn capital. And the restricted payments clause is the provision that most directly affects sponsor returns. Understand precisely what DSCR level, what reserve account balance, and what absence of default conditions must be satisfied before the SPV can distribute cash to sponsors. A restricted payments clause that is too restrictive can trap equity in the project for years beyond what the model projects.
The security package clause requires separate legal review. DFIs typically take a pledge over the shares of the SPV, an assignment over the offtake agreement, an EPC contract, a mortgage over the project site, and a charge over all project bank accounts. Each of these security interests must be perfected under local law, and in many African jurisdictions, perfecting a share pledge or land mortgage requires regulatory consent, takes time, and may have costs that are not in the developer's budget. Identify the security package requirements and the perfection timeline in the first week after receiving the term sheet. The conditions precedent to first drawdown are the list of deliverables that must be completed before the DFI releases its first loan disbursement. 7 CPs appear in almost every DFI transaction. First, all project agreements executed and in final form, offtake, EPC, O&M, and land. The DFI will review these agreements one final time at CP stage. Second, ESIA disclosed, published on the project's public website and on the DFI's website for a minimum of 120 days before first draw. This is a hard deadline that cannot be compressed regardless of how quickly other CPs are satisfied.
Third, equity fully deposited, either in a designated escrow account or already drawn and applied to project costs, demonstrating equity-first compliance. Fourth, all permits and licenses valid with no pending legal challenges. Fifth, construction insurance in place. All policies issued, the DFI noted, as loss payee. Sixth, legal opinions from both local and offshore counsel confirming the validity and enforceability of all project agreements and the security package under applicable law. And seventh, a financial close certificate from the independent engineer and DFI legal counsel confirming all conditions are satisfied. Missing even one CP delays first draw. Developers must track CPs as a separate project management workstream from the day the term sheet is signed.
DFI pricing has three components: the base rate, SOFR for dollar loans, Euribor for euro loans, is a market rate that resets periodically. The credit spread is the DFI's risk premium, which reflects the project's country risk, sector risk, and tenor. For African infrastructure, all-in rates typically range from 6 to 11% in dollar terms. The lower end applies to low-risk country, energy transition transactions supported by concessional windows. The upper end applies to frontier markets, early-stage sectors, or projects with complex risk profiles. Blended finance windows, particularly the Green Climate Fund or the climate facilities at AfDB, can bring the effective rate down by 1 to 3 percentage points by subsidizing part of the interest cost.
Developers often focus exclusively on the interest rate when comparing DFI term sheets. But the total cost of financing includes commitment fees on undrawn balances, monitoring fees for the life of the loan, front-end fees paid at signing, and prepayment fees if the loan is refinanced early. A DFI loan with a lower interest rate but higher fees and a prepayment penalty may cost more over its life than a slightly higher rate loan with no prepayment restriction. Model the total cost of financing, not just the headline spread, before choosing between competing DFI offers.
Most large African infrastructure transactions are not financed by a single DFI. They use co-financing structures that distribute the lending across multiple institutions. The AB loan structure, pioneered by IFC, places IFC or AfDB as the A lender, holding a portion of the loan on their own balance sheet while syndicating the B loan to commercial banks. B lenders benefit from the DFI's preferred creditor status, a sovereign agreement between the borrowing country and the DFI that historically reduces the risk of payment interruption in debt service crises. Commercial banks cannot obtain this preferred creditor status on their own.
Parallel financing involves multiple DFIs, each committing separate tranches under separate loan agreements, but coordinating their due diligence and conditions precedent. AfDB plus IFC plus DEG is a common combination for energy transactions above $50 million. Each DFI conducts its own review, but they typically appoint a shared independent engineer, share technical due diligence reports, and align on CP satisfaction. Developers in parallel financing arrangements must manage 3 separate DFI relationships simultaneously, which is demanding but manageable if the project team has the capacity.
Understanding which DFI window applies to your project is critical. DFIs operate in 2 modes. The sovereign window lends to governments or to entities with a sovereign guarantee, typically national utilities, ministries, or state-owned enterprises. Sovereign loans are usually concessional and subject to strict procurement requirements, competitive tender under the DFI's procurement framework. The non-sovereign window lends directly to private sector project companies, SPVs, without a sovereign guarantee. Non-sovereign loans are priced at commercial spreads and use the project's own assets as security.
For most private infrastructure developers in Africa, the relevant window is non-sovereign. But many African infrastructure projects have a government off-taker, which means government payment risk. The partial risk guarantee bridges this gap. A PRG is a guarantee issued by AfDB or the World Bank, under which the DFI guarantees a defined government payment obligation to the private lender. The PRG transforms sovereign payment risk into DFI credit risk, which commercial banks and non-sovereign DFIs are willing to accept. If your project involves a government off-taker and you are seeking non-sovereign financing, a PRG is often the mechanism that makes the transaction bankable.
7 DFI engagement mistakes consistently kill transactions before credit committee. Mistake 1. Approaching too early. Submitting a concept note before the offtake, land, and ESEA framework are in place forces the DFI to decline and damages the developer's credibility with that institution. Mistake 2. Wrong contact. Emailing a DFI's general inbox or contacting a country representative who is not the sector specialist means your project sits unread in someone's inbox rather than in the pipeline of the person who can actually advance it. Mistake 3. An unaudited financial model. A developer who submits a model that has not been independently reviewed is asking the DFI's financial analyst to do quality control work on the developer's behalf. DFI analysts do not do this.
Mistake 4. Requesting 100% debt. DFIs require the developer to have skin in the game. A project with no committed equity is a project where the developer bears no downside risk, and DFIs do not lend into that structure. Mistake 5. Beginning construction before the SIA is completed and disclosed. DFIs cannot retroactively finance construction that began before their environmental and social standards were applied. This mistake is irreversible. It permanently excludes the project from DFI financing. Mistake 6. Responding to DFI due diligence queries late or incompletely. DFIs have internal review timelines. A developer who takes 6 weeks to respond to a 2-week query list pushes back the credit committee date by at least a quarter. And mistake 7. Changing project scope after the IM has been submitted without formally resubmitting updated documentation.
The common thread in all 7 mistakes is that they impose costs on the DFI. Cost of time, cost of rework, and cost of reputational exposure if the DFI approves a project that subsequently fails. The developer who eliminates these costs signals professionalism, project quality, and development capability. That signal is evaluated before the first financial number is ever reviewed. DFI engagement is partly credit assessment and partly counterparty assessment. Your conduct during engagement tells the DFI how you will conduct yourself as a borrower for the next 20 years. DFI preferences vary by sector. In energy, the climate DFIs, AfDB, IFC, DEG, Green Climate Fund, and the European Investment Bank prioritize solar, wind, and storage. Coal is excluded from all of them. A bankable PPA is the absolute prerequisite. DFIs will not begin energy sector engagement without a substantially negotiated power purchase agreement. In water and sanitation, the AfDB Water Security Fund and IFC's non-sovereign window are the primary sources. Government off-takers are the norm, which means PRG structures are common. PS5 land and resettlement risk is elevated in urban water projects where informal settlements occupy the project footprint.
In transport, AfDB's sovereign window finances national roads, ports, and rail under government programs. IFC finances PPP toll road transactions where the revenue model is private. Land acquisition is consistently the critical path item. PS5 resettlement in transport corridors can add 12 to 18 months to project development if not started early. In digital infrastructure, towers, fibre, data centres, IFC, DEG, and FMO are the active lenders. The anchor tenant agreement is the functional equivalent of the offtake agreement. Without it, DFI engagement on a digital infrastructure project will not progress.
African Infrastructure Building, Corporate Limited, AIB Corp Ltd, is a specialist project, development, and advisory firm. We work exclusively on African infrastructure transactions. Our team has structured and supported transactions across energy, water, transport, and digital infrastructure, from project concept through financial close and construction. We understand DFI requirements from the inside because we have worked on DFI transactions, reviewed DFI documentation, and negotiated DFI term sheets and loan agreements on behalf of developers. Our advisory work is grounded in the same technical standards that DFIs apply when they audit a project, not in the more optimistic assumptions that developers often prefer.
This is the precise expertise that developers need when approaching DFIs. Not general financial advisory, specific knowledge of what AfDB's non-sovereign operations window requires at each stage, what IFC's credit standards look like for an energy transaction in a frontier market, how DEG approaches a PPP transport project. That institutional knowledge is not something you can read in a website. It comes from working in these processes repeatedly.
AIB Corp Ltd provides 4 DFI engagement advisory services. First, DFI engagement strategy. We advise on which DFI to approach, in what sequence, with what project package, and through which internal contact. We have direct relationships with sector specialists at AfDB, IFC, DEG, and FMO. Second, Information Memorandum. We draft the full IM to DFI standard, covering all 10 required sections, stress-tested against the assumptions we know DFIs will apply. Third, Due Diligence support. We manage all 4 DD workstreams on the developer's behalf, coordinating IE, legal counsel, ESIA advisors, and financial model reviewers against the DFI's timeline. Fourth, Term sheet negotiation. We review the DFI term sheet, flag adverse provisions, and negotiate pricing, security, covenants, and CPs aligned to the project's economics.
Zara, the point about the IM being a readiness demonstration rather than a pitch really changed how I think about this. Most developers treat it like a fundraising document. But the DFI is not an investor you are persuading. It is a structured lender who is assessing whether the project meets its credit criteria. The document needs to prove readiness, not project aspiration.
That is exactly the mindset shift, and it applies to the entire engagement. The developer who treats DFI engagement as a sales process, where persistence and enthusiasm compensate for incomplete documentation, will frustrate the DFI. The developer who treats it as a structured credit process, where every query is answered completely, every deliverable is submitted on time, and every document is DFI standard quality, will move through the 8 stages on schedule.
And the timing point is something I want to underline. 12 to 24 months to financial close. Developers who begin DFI engagement expecting to close in 6 months are either very exceptional or they will be disappointed. Modeling the engagement timeline correctly and planning the development budget accordingly is part of the DFI engagement strategy.
It also means that the developer who wants to close in month 24 needs to have started DFI engagement in month 1, not month 18. The engagement journey cannot be compressed by intensity. It can only be accelerated by quality of documentation, quality of responses, quality of the project itself. Get those right, and the DFI process moves at its designed pace. Get them wrong, and every stage adds months. That is Episode 11, the DFI Engagement Strategy for African Infrastructure. 8 stages, 7 readiness criteria, a 10-section information memorandum, 4 due diligence workstreams, 7 mistakes that kill transactions before credit committee, and the DFI pricing and co-financing structures that determine the economics of your loan. If you found this episode valuable, subscribe to the channel. AIB Corp Ltd publishes a new episode every week on building bankable African infrastructure projects.
And share this episode with developers who are preparing to approach DFIs. Most of the mistakes we discussed are preventable, but only if developers know what they are before the engagement starts.
If you are currently preparing a DFI engagement, identifying the right institution, drafting an information memorandum, or managing a due diligence process, AIB Corp Ltd can support you. We provide DFI engagement strategy, IM drafting, due diligence management, and term sheet negotiation, all on a retainer and success fee basis aligned to African project budgets.
Visit www.aibcorpltd.com or contact the team directly at projects@afroglobaltrade.com. Initial consultation is confidential.
Episode 12 covers the infrastructure, SPV, and legal structure, the project company, the shareholder agreement, the security package, and what DFIs require from the legal structure before they will lend. If you have watched episodes 7 through 11 and have all the technical, commercial, environmental, and financial pieces in place, episode 12 shows you how to assemble the legal structure that holds everything together.
That is the final piece before you reach financial close. Do not miss it.
Subscribe. Leave a comment with the question or challenge from this episode you found most relevant to your own project, and share the episode with one African infrastructure developer who needs to understand DFI engagement before they approach a DFI.
AIB Corp Ltd, African Infrastructure Building Corporate Limited. See you in episode 12.
www.abcorpltd.com